Hi, everybody, and welcome to FinFacts Live. Today, I'm joined by Annie Lai out of our Seattle/Bellevue office. FinFacts Live is where we do a quick interview regarding our latest FinFacts article. Annie wrote a great article this last week on the yen and why it's at a 40-year low and is in a bit of a tough spot. So, Annie, what happened to the yen and why has it weakened so much?
So Japanese yen started hitting back the headline news in the past months because it officially broke the psychological level 160 in late July, which is a 40-year high for dollar yen. And in other words, it means that the yen was at its weakest level in 40 years. And a part of the driver was because the interest rate differential between the US and the yen rates. For example, I'll give you a quick guidance that 10-year is traded at 4.7% and 10-year JGB is traded at 2.9. So theirs is a 180 basis point gap. And what does that implication from the weaker yen? Number one, it makes the import for Japan more expensive, which eventually will fit into their inflation. And on the other side, it makes Japanese exports more competitive. And in that perspective, it raised concern in the US because that will widen the trade deficit between the US and Japan.
So, Annie, why does the US care so much about the yen? And what would a stronger yen mean for the US economy and for trade?
Because currency directly affect the trade competitiveness. If a country currency gets weaker, its exports become cheaper for overseas buyers. US dollar nowadays still the dominant currency in global trade. So if the yen weakened by say 50%, and a Japanese product that costs about like 1,000 yen would become roughly 50% cheaper in dollar terms. And assuming everything else stayed the same. And that makes Japanese product more competitive internationally and also compared to the product made in the United States. So ultimately, that would put even more pressure on the US trade deficits. That means less compelling for the US products. And so a stronger yen could help reduce some of the trade tension between the US and Japan. And also it could make Japanese products more expensive in the United States. And more broadly, it could help reduce some of the trade imbalance caused by this extremely weak yen.
You had mentioned that Scott Bessent and Sane Takeichi have different views. What exactly do they disagree on?
So basically, Bessent and Takeichi, they agree on the same directions that Japan should embrace the higher rate environments, not just because Japan has to do that in favor, in Washington's favor, but also because Japan owns those fundamentals to support a higher rate environment. There are a couple of reasons for that. Number one, Japan has a strong wage growth. Number two, the inflation is approaching BOJ's target 2%. There's data released earlier that the wholesale inflation actually rose to 7.2% year on year in July. The index actually is similar to the PPI in the United States, which we can imply that it eventually will feed through to consumer prices. So the real debate right now between Washington and Tokyo is how quickly Japan should get there. So Takaichi has been more cautious about like moving too quickly, particularly that there was a geopolitical risk broke out in March. And the potential impact of higher rates might have some impact on its recovering economy. And also, the BOJ has already raised twice in the past 1 year. So ultimately, I think it's less about whether Japan wants to go. It's more like how fast it wants to get there. And I believe that they will take more aggressive actions in September meeting.
So how would a stronger yen and a more hawkish BOJ, Bank of Japan, affect U.S. interest rates?
So to support a stronger yen, as we see in the past 2 weeks, that intervention, of course, is a way, but it's more a temporary solution. In the long run, Japan still need to adopt a monetary policy to support a stronger yen. So if the BOJ raise interest rate, Japanese bond would become more attractive because the interest rate differential between the US and Japan would narrow. So Japanese investor as the biggest bond holder of the US, they would have a less incentive to buy US Treasury. Instead, they would allocate or deploy their capital back into their domestic bonds, and that would support more Japanese yen demands. And what's the implication to the US Treasury? I think at the end, there's going to be, as we discussed in earlier podcasts, that there's going to be more carry trade unwind, and the back end of the US Treasury yield go higher. So in the long run, I do expect that yield to remain well supported and with more pressure on the back end of the curve. So because I see limited downside for the yield curve for now. So if you're looking for refinance or you're about to finance a property, a project, I strongly suggest to lock in the interest rate at the very beginning.
So, Annie, if I were to sum up this conversation, it sounds like we're still a little bit bearish as to the direction of rates. There are structural elements that are going to hold rates high and potentially higher. So, the practical implication for the commercial real estate investor would be to lock in deals today if you have a deal to do, rather than kind of waiting it out to see what happens. It seems like the structural context would be that waiting may lead to higher rates.
Yes, I agree with you, Evan. In the past year, I have been very bearish on the U.S. Treasury, and we've been suggesting the borrower to lock in the rate as early as possible and don't wait. And we have seen a couple of successful deals that the sponsor lock in the rate, and once the deal is closed, the Treasury actually increased by another 30 to 40 basis points. But since the sponsors has already locked in the rate, they are immune to these rates environment rates volatility. So conclusively, don't wait and lock in the rate as early as possible because I see limited downside of the Treasury yield curve to go lower.
Great. All right. And as always, go to gspartners.com/FinFacts. You can read Annie's latest column there. Sign up for our newsletter. Again, gspartners.com/FinFacts. Thank you, Annie, for joining today.
Thank you, Evan.